Many buyers think the Federal Reserve sets mortgage rates. So when the Fed holds rates, cuts rates, or talks about inflation, people expect mortgage rates to move in a straight line. But that is not how the mortgage market really works. The Fed is important, but the Fed does not directly set your 30-year fixed mortgage rate. The Fed controls short-term interest rate policy. Mortgage rates are long-term rates. They are more closely connected to the bond market, especially the 10-year Treasury yield and the market for mortgage-backed securities. That is why mortgage rates can rise even when people expect the Fed to be done raising rates. And it is why mortgage rates can fall before the Fed actually cuts. Markets move on expectations. They do not wait politely for the official announcement. Let us break it down. When a lender makes a mortgage, that loan often does not just sit quietly on the lender's books forever. Mortgages can be bundled into mortgage-backed securities and sold to investors. Those investors compare mortgage-backed securities with other investments, especially Treasury bonds. If Treasury yields rise, investors usually demand higher returns from mortgage-backed securities too. That pushes mortgage rates higher. If Treasury yields fall, mortgage rates often get room to fall as well. But the relationship is not perfect. Mortgage rates also include a spread. That spread compensates investors for risks like prepayment, duration, and uncertainty. If investors feel mortgage risk is higher, the spread can widen. That means mortgage rates can stay elevated even if Treasury yields improve. This is why buyers can get frustrated. They hear that the Fed might cut rates, they hear that inflation is cooling, but the mortgage quote does not fall as much as expected. The reason is that the mortgage rate is not a simple Fed rate copy. It is a market price. Now inflation matters because inflation affects bond yields. If inflation looks sticky, investors demand more yield to lend money for a long time. Higher bond yields can push mortgage rates higher. If inflation cools and the economy weakens, bond yields can fall. That can help mortgage rates. But again, it depends on expectations. If the market already expected good inflation news, rates may not move much when the news arrives. If the news surprises the market, rates can move quickly. This is why mortgage rates can change day to day. They react to economic data, jobs reports, inflation reports, Treasury auctions, Fed speeches, global risk, and investor demand. The Fed is one voice in the room, not the only voice. For buyers, this matters because waiting for the Fed can become a trap. If you wait for the Fed to cut rates, the market may have already priced in part of that cut. If rates fall, home buyer demand may come back. If demand comes back, home prices may stay firm or rise. So the buyer who waited for a lower rate may face a higher price. That is why the question is not, will the Fed cut? The better question is, what monthly payment can I afford under several rate and price scenarios? A Fed decision is not a mortgage plan. It is one input. Here is what buyers should watch instead. Watch the 10-year Treasury yield. Watch inflation reports. Watch labor market data. Watch mortgage spreads. Watch home inventory. Watch local home prices. And most importantly, watch the actual loan estimate from lenders. The rate you qualify for may not match the national average. Your credit score, down payment, debt-to-income ratio, property type, loan size, and points can all change the quote. So even if average mortgage rates fall, your personal offer may not fall by the same amount. This is why the Fed myth is dangerous. It makes buyers focus on one headline instead of the real decision. Mortgage rates are shaped by the Fed, but not controlled by the Fed alone. They move through bonds, inflation, investor demand, lender pricing, and borrower risk. The smarter buyer does not ask only what the Fed will do. The smarter buyer asks, if rates move up or down, what happens to my payment? If prices move too, what happens to affordability? If I wait, what risk am I taking? If I buy now, can I handle the payment without depending on a future refinance? That is the real mortgage rate question. This matters even more because mortgage headlines often compress a complicated market into one simple sentence. The Fed may cut rates. Inflation came in cooler. Treasury yields moved higher. Mortgage rates dipped. Each headline can be true, but none of them alone tells the buyer what to do. For example, if inflation cools, bond yields may fall. That can help mortgage rates. But if the same data makes buyers more confident, housing demand may improve. More demand can support higher prices. So the buyer may get a lower rate, but face stronger competition. That is why mortgage affordability is not just a rate story. It is a rate, price, income, supply, and payment story. The Fed is part of the background, but the buyer still has to solve the foreground. What is the payment? What is the cash to close? What is the loan estimate? What is the local inventory? What is the risk if rates do not fall? And what is the risk if rates fall and competition returns? Those questions matter more than trying to predict one Fed meeting. There's also a timing issue. Mortgage lenders can reprice quickly when bond markets move. Sometimes rates change before the average consumer even understands why. A jobs report, inflation print, Treasury auction, or Fed speech can move markets fast. That does not mean buyers should panic. It means buyers should understand that mortgage rates are market prices. Market prices move. And because they move, the buyer needs a range, not a single hoped-for number. A smart buyer can ask a lender, what is my payment at today's rate? What would it be if rates moved up by 0.5%? What would it be if rates moved down by 0.5%? How much would points cost? What would the loan estimate look like in each case? Now the buyer has a decision range. Not just a headline. The Fed may influence the direction of rates, but the buyer still needs to protect the household budget. No central bank announcement can do that part for them. That is why Fed mortgage rates is such a powerful keyword, but also such a dangerous misunderstanding. People search it because they want a simple connection. But the truth is a chain. Fed policy affects expectations. Expectations affect bond yields. Bond yields affect mortgage-backed securities. Mortgage-backed securities affect lender pricing. Lender pricing affects the quote. And the quote affects the buyer's payment. By the time the Fed headline reaches your loan estimate, it has passed through several markets. That is the real story. Educational content only. This is not financial, mortgage, tax, or legal advice. Always compare real loan estimates from licensed lenders before making a mortgage decision.